Thank you for joining me on Concept Corner. This is the sixth of six presentations. It's been a great exercise here putting this together. I hope you guys have enjoyed it, and more so, I'm happy that we have some content for you to come back and look at the presentations later. These concepts were intended to help you with day-to-day concepts. Not that you should be watching this and walk away and be fully up to speed. Jordan and I are, of course, always here to support you in your practice, but just give you a better idea of the opportunities that are out there. So thank you for coming along with me throughout the Concept Corner presentations. Today is the Tax-Free Savings Account Maximizer, TFSA Maximizer. Everything I've done to date is now on my YouTube channel. So we did the additional deposit rider launch, we did personal and corporate legacy builder, insured retirement concept, thriving in the family market, and annuity funded life insurance. Last week was now been posted as well. So you can just simply search Mark Morano on YouTube, and you'll be able to pull up any of these at your convenience. And of course, you give me a like or a comment. I'd appreciate that as well. So basic format, we start now 9:30 sharp. We'll be done by 10 or so. Then stay on for any questions. And of course, if you wanted a private question, reach out to myself and Jordan afterwards. So the agenda for us today, as always, a quick update of Empire Life. We're going to look at tax-free savings account maximizer, the concept and how to build it, and then questions and answers at 10. So let's just quick update, get this out of the way. So just to make sure we're all up to speed, Empire's done a tremendous amount of updates lately. I think we're doing a great job as a company getting new and exciting stuff out there to meet all of our advisors and clients' needs. So Solution 25 has taken off with rapid success. So I have Term 25 for life insurance, which is a really great alternative to mortgage insurance. If you haven't seen that yet, take advantage. Additional deposit provider, we're doing some great stuff, great quotes on that. Excited about all the quotes I'm putting out there. Should see some real winners come out soon. Extra compensation on the segregated fund side, 10% bonus on gift deposits up until the end of September. Paramedical services are now up and running. So if you do have a case that does go above our higher non-medical limits, we are able to get DynaCare and Exam 1 out there. Head office has told us that, of course, there is a backlog, and DynaCare and Exam 1 expect to be more back on service standards by middle of August. So just some patience as the industry as a whole, just as we kind of get through the backlog of cases. So take advantage there. And as always, we at Empire we take care of all your ordering for your requirements. So whether you do fast and full or paper app, we do all your ordering for you. So just one less thing you have to do. And if you haven't taken advantage of it yet, critical illness return or premium offer without underwriting is available and ending July 20th if you wanted to take advantage of that special offer to add ROP on your CI contract. And one that I can never go without mentioning is our summer e-bundle commission bonus. Incentives to the end of September. We have dramatically increased the compensation on fast and full and the e-bundle, which is your EHQ and e-policy delivery combination. So if you've removed the questions by DynaCare and you've done an electronic delivery, your compensation could be as high as 20% more gross comp in an environment where some advisors are, struggling a little bit more than normal to get business, or you're successful, whatever it may be. Getting 20% more gross compensation is nothing to sneeze at. So take advantage of a great process, best in industry, great products, and paid more for it. It's a real triple win on that. So take advantage of the summer e-bundle bonus. Okay, just get that out of the way. I wanted to give an update. TFSA Estate Maximizer. So this is a very unique concept that Empire's built. And the story behind this, it's only a couple of years we've had this, less than a year and a half since we've had this concept on our software. It originated from an Empire Life wholesaler conversation with another advisor. It was a insurance specialist at one of the large investment houses, one of the bank firms. And the conversation revolved around the TFSA specifically and how most people underutilize the TFSA and the opportunity. In a completely tax-free environment, most people hold very low risk, low return investments, such as savings accounts and GICs. So the conversation revolved around approaching some of these individuals of a certain age and a certain market, that maybe we can better utilize this money if it was earmarked towards an estate purpose. So by looking at targeting those with large TFSA balances, those that have been putting it in since the launch in 2009 and have done, have put the deposits in, but haven't seen the growth that they're looking for because they've been sitting in bank accounts or, again, low-risk GICs, if this money is not necessarily something they are going to be using for retirement purposes, or it's money that they want earmarked for legacy purposes, and legacy meaning leaving money to children or grandchildren or charity, or, you know, there is a bit of a want and a need and any concept that we talk about to leave something to someone, that we can use the power of permanent life insurance combined with tax-free savings accounts to significantly increase the estate value. Now, when I talk about other concepts, legacy builder or corporate insured retirement, what we're talking about a lot of times is reallocation of assets, where we're taking from this pile, moving to that pile. And we're doing a bit of that here, but really what I want to take advantage of is both. With the TFSA Estate Maximizer, it's not a matter of one solution is better than the other. I want to keep on using the TFSA, but I also want to integrate life insurance into the scenario so that we can maximize both in the most tax efficient, tax sheltered manner possible. So in this concept, it's not a matter of stop using TFSA. It's not a positive. It's very much so positive and should be used more so. The concept really revolves around using insurance to complement and to maximize the overall estate value that we can use using life insurance and TFSA. So a little bit of preamble on that. So just a little bit of history. TFSA was introduced in 2009. It allows us to set aside money in eligible investments to watch the savings grow tax-free throughout your lifetime. Anything invested in TFSA and the eligible investments grows tax-free and can be withdrawn tax-free. So here's our limits from 2009, 2012. We could put in $5,000 into a TFSA. 13 to 14 went to $5,500. The conservatives gave us $10,000 in 2015. And then in 16, Morneau took it back and put us back down to $5,500. And in 2019, it's $6,000. And this is a little snippet from the Empire's financial facts. And we have now $6,000. Cumulative total deposit into TFSA, $69,500. Now, again, I deal with many wonderful investment advisors, do a great job investing for their clients. But as a general consumer, general Canadian out there, how are most people using the TFSA? And really, sadly, I think for most, and it's a lot to do with the marketing out there, it's basically used as a piggy bank, meaning we leave our savings in cash sitting in this account, and it's growing tax-free, but it's not growing very rapidly. The marketing of this, the TFSA, maybe from the beginning was poor, where it should have been called a tax-free investment account versus a tax-free savings account, because the banks and the general marketing in general have not exploited the advantage of a TFSA, that I can have some very aggressive investments in there and not pay any tax on the growth. This is a great article, and I'll send this in my follow-up email that I pulled from the Globe and Mail. It's almost a year old at this point, but it's written by Brenda Bowe. Canadians should be making better use of their TFSAs. Research shows that the TFSA, a quote from the article, research shows that the TFSA has been used more of a piggy bank than a tax-efficient investment vehicle. And financial advisors believe that is a missed opportunity for investors. The top 5 holdings in a TFSA from the survey are 42% sitting in cash, followed by mutual funds at 28%, stocks at 19%, GICs, term deposits at 15%, EFTs at 7%. So what that really means is 57% of a TFSA investment sitting in cash or cash equivalents, which really isn't the driver or the best use of this type of product. So for those, maybe the clients are risk averse, maybe they don't know better, maybe their advisor hadn't told them, maybe they deal with the banks and they didn't get the best of support. Whatever the scenario may be, great. They obviously believe in using TFSAs. They've made the deposits. They believe that they want a tax sheltered environment, so they're taking advantage of TFSAs, and they want conservatives because they're keeping their stuff in cash and GICs. Hence, we open up the window for insurance. We can look at the TFSA Maximizer strategy, where we can help the client optimize these fancy words. We make their estate bigger by combining the power of insurance and using TFSA. The advisors that use this concept will typically look at the existing TFSA balance that the individual has built up to date and future TFSA deposits, and we're going to reallocate the current TFSA balance as well as the future TFSA deposits that was earmarked for going into the TFSA to go into the insurance. We're going to provide a tax-free death benefit for the beneficiaries outside of the estate and minimize probate fees. And then we've now recreated more TFSA room by reallocating some of that money towards insurance premiums. And again, I've said this at the beginning, this is not a side-by-side comparison where the insurance is better than the TFSA. This is not one of those concepts. This concept is a matter of combining both into one strategy that ultimately builds a larger legacy value. Target market, we always show this slide, clients ages 50 plus. Why is it always 50 plus? We believe these markets, people have a legacy want. They've looked at the opportunity. They've looked at maybe retirement, potential retirement, looking at what they want to do with their success. They've above average incomes, hopefully, and large disposable income amounts and savings that can be used towards a concept such as this. They contribute to their TFSAs regularly is the target, and they want to maximize the legacy and their legacies and pass them to their heirs or favorite causes when they die. So that's a typical market. So just on the slide, I don't want to skip over too quickly. You know your clients. Really, in any of these concepts, there has to be a want or a need of some sort to leave something or a charitable inclination where we can utilize, we want to pass on the most money possible. So these concepts have less to do with about an immediate need as they do about passing along of legacy. So when we're approaching our clients, the want has to be there, and then we use the insurance as part of the strategy in order to really get the most money out of most money as a legacy as possible. So how does it work? So we are going to reallocate the value in the existing TFSA to insurance premiums for a limited pay par policy. So we're going to take the existing TFSA and remove it tax-free, because again, it is a TFSA, and put it into a limited pay par and 8-pay contract. We're going to apply the planned TFSA contributions that they're going to go forward into the insurance contract. And then once the policy becomes paid up, they can go ahead and continue to resume their annual contributions to the TFSA. So why would you consider using TFSA Maximizer as an idea, as a concept? And obviously is a way to increase your estate value at death. Funds pass directly to a named beneficiary outside of the will. The payment of the life insurance proceeds to a named beneficiary avoid probate and any processing delays of winding up an estate. Funds maintain a tax-exempt status. We've now used another tax-exempt vehicle, so I've created more additional TFSA deposit room by reallocating my existing TFSA deposit. And where possible, credit protection for individuals and beneficiaries, if that's something of importance to a client. So a lot of opportunities here to think about. The probate one being a wonderful opportunity as well, named beneficiary going direct to a person versus having to go through the will and being released that way. So possible reasons why we do TFSA Maximizer. Let's look at our case study. So Jack and Jane. So standard Canadian couple. They are 63 and 59 respectively, non-smokers. And they have been depositing their max or close to maximum deposit in the TFSA. And they currently have accumulated between the two of them $130,000 of money. So really, if you look at the overall deposits they've put in, they're not getting much growth whatsoever in that they both had 60-some-odd thousand of room. They're averaging about a 3.5% rate of return, so nothing extraordinary on their recent returns. They want to leave the TFSA as part of their legacy to their children or grandchildren, and they have other investments that will generate sufficient retirement income. They plan to continue to contribute the maximum TFSA contribution each year, which is $6,000 each or $12,000 total. So we have a $130,000 pot of money in the TFSA, and we have an ongoing amount of $12,000 a year earmarked towards the TFSA deposits. So in approaching them, they have a legacy wish. They have money in underutilized monies being used, and they have a want to pass this along. So what we could consider is the TFSA Maximizer. For the next 8 years, we're going to use an 8-year window. We're going to take their existing, their current contributions, so that's $12,000 a year, and we're going to put that in. We're going to take that into the policy. We're going to take their existing TFSA of $130,000 and reallocate that into the policy. So again, we're taking the 130 divided by 8 years, putting it into the policy, and their contributions of $6,000 a year each, $12,000 total. We're going to put those into an insurance contract as well. Okay. So to be clear, years 1 to 8, reallocating the money that was earmarked towards TFSAs, and the existing balance into an insurance contract. And then we've also accumulated extra contribution during those 8 years of $96,000. So we've depleted the TFSA for $130,000 plus of ongoing contribution rooms, assuming we stay at $6,000 per person per year. Hopefully that will increase, but let's assume 6,000 stays. So we reallocate what we have, we build up our contribution room. In our software, just to show you some of the snippets of screens you will see, and how we calculate our premiums. Okay, our current TFSA balance $130,000. If I say calculate my insurance premium, you will get a box that pops up that says, in order to use current investments $130,000, you will require an annual premium of $28,250 paid over 8 years. You'll need to exit AddCalc, run an illustration using the aforementioned premium stream, and then rerun this concept using the specified investment. How do we get to $28,250? Is we're taking their ongoing contributions of $12,000 a year, so $6,000 each for Jack and Jane, 6,000 times 2, we're putting $12,000 a year, and we're simply taking the 130 divided by 8, which is $16,250. And we're going to take that $16,250 plus $12,000, and we're going to put $28,250 into an 8-pay insurance contract. Okay. The concept, when it was built for our 8-pay contract. So you can either use our 8-pay guarantee, which is OptiMax or Estate Max, or you can use our new offset option. So in this particular scenario, I'm going to use an offset just to demonstrate our ADO. So I can do an 8-pay. But if you're using the TFSA Maximizer concept, it's built for an 8-year payment stream. Hopefully we build a little more flexibility in that going forward, but currently it's based on 8 years going into the concept. So from a software standpoint, this is a snippet of the Envision software. I really want to make sure I show you how to build it. We have 2 clients here. We have John and Jane, 63 and 59. We are using an Estate Max contract, joint last to die, face amount. We're solving for premium offset. So I'm doing a life pay here. You can see it's ticked off life pay. We're offsetting at year 9. So that means we're paying for 8 years. We're buying a total of $431,902 of life insurance, and we're putting an additional deposit option from years 1 to 8 at the maximum level, which is $17,498. Gives me a total annual premium of $28,250. And again, that was made up of my TFSA plus my annual contribution. So we're committing to $28,250 going into the concept. I'll recreate this momentarily, but just to show you where these numbers, how we're building it. So we're going to stick this into AddCalc. AddCalc gets us a beautiful presentation. This is the client presentation initial page. This is your best presentation tool. Great marketing piece that we've put together, why you would do something like this and put in all the numbers on paper. Gives you your basic assumptions. John and Jane, here's your assumptions page. We're buying an Estate Max using 8-year premiums and depositing $12,000 of TFSA deposits, as well as $16,250 of my TFSA balance, and we're depositing $28,250. Now, this is a summary page that you would be going over. So the orange is your TFSA maximizer concept, and then your gray is your overall state value. So I've put in $28,250 of insurance premiums, of which $16,000 is a transfer from my existing TFSA. So my new TFSA balance, we had 130 minus 16,250 equals $113,000 left for the first year. We get a little bit of growth on that. My overall estate value is my TFSA plus my life insurance is then $597. So I've taken my value now almost to $600,000. Year 2, we spent $28,000 in premiums minus out of my TFSA. It's coming from $16,000 out of my TFSA, so it gets down to we subtract $16,000 off from $17,731, gives me $101,481, et cetera, goes throughout the years. By year 8, my TFSA balance is going to be approximately 0. Still a little bit of growth there from the interest earned, but we've taken the full amount out of the TFSA, and we have paid $28,000 in premium. After 8 years, the insurance contract is fully paid, and we're going to make the assumption that at year 9, they're going to start to pick up again their annual TFSA deposits. They didn't do any deposits from year 1 to 8 because we're putting that money towards the insurance premiums. So again, $16,250 plus $12,000 is the $28,250. Okay. Beginning at year 9, they can continue, if they still have the financial means to do so, put in the $12,000 into the annual deposit of their TFSA. So continuing to maximize both. So really, as I said at the beginning, the idea of this concept was to marry both together. I'm going to take advantage of the TFSA deposit I've built to date, continue to make TFSA deposits down the road, and if I have extra cash flow and more non-reg money, refill the pot of money that I've taken away. Okay. So overall, increasing the overall estate value dramatically by combining the TFSA as well as ongoing insurance, TFSA, and ongoing deposits. And just as a summary, these are always nice pages to show your clients, just to show what we have done ultimately is by using the concept versus not using the concept are the two yellow columns here. So at year 20 as an example, the TFSA Maximizer concept has increased the overall estate value to just over $900,000 versus if they would have continued depositing and earning an average of 3.5%, in their TFSA would have grown to just over $600,000. So we've increased the overall estate by almost $300,000 or 49%. So again, not that we don't need TFSAs, don't want to use TFSAs, but we've given it a kickstart or a jump by taking a part of their money and putting it into the insurance contract to increase the overall estate value. So, you know, years 10, 20, 30 down the road, Jane being the younger of the two lives, we've increased even 30 years later, we've increased the estate value by 20%, almost $200,000, which is a substantial amount of extra money based on the overall amount left as a legacy. So the end punchline to the whole presentation is the overall estate value with limited amount of extra risk using the insurance contract. So really, now the question is, well, how do I build for if I have my own clients? And hopefully during my presentation, you thought of some clients that are heavy into TFSA deposits and maybe not overly risky in their investment outcome that maybe I want to build one of these. And again, Jordan and I are always available to help you build, but it's important that I show you a little bit of how to get started on this guide. So we have, I've already created for you for the sake of time. We have John and we have Jane. They're both standard, so I no ratings, 100%, so they're standard risk. I've coverage tab. I've decided to use paid up additions. And why paid up additions is ultimately we're trying to grow a little bit faster in terms of overall death benefit and allows me to do an ADO offset. To do an ADO offset, I need to choose paid up additions. So because I'm doing a life pay and I only want to pay for 8 years, I must choose the paid up additions. If we're doing a limited pay contract, maybe using enhanced in the scenario, but because I want to do an offset, I need to choose paid up additions as my participating option. Okay, if you have more questions on that, please ask me later. Again, face amount, premium offset, we're going to do year 9, which again means that we're going to pay for 8 years and we're going to offset or take a holiday beginning at year 9. So a little bit of confusing verbiage that the offset actually begins in the 9th year, meaning we've paid 8. Okay, so it's a life pay cost of insurance. You're committing to paying for life, but we're going to only deposit premiums based on 8 years and stop paying in the 9th. The additional deposit option is maximum allowable for this particular face amount of $17,498. We're going to pay that for 8 years. Now, the trick to this, and again, as you're playing with this, and again, always here to help, but if you want to play around with the software yourself, I wanted to get to $28,250. Unfortunately, there's not a super easy way of getting to that exact number. It's a lot of trial and error. So what I will literally do is play around with the numbers here to try to get us to a number that makes some sense. If I take off $1, for example, and I now make it 901, it goes below 49,250. So for me, it's a little bit of just trial and error and playing. It's not the most sophisticated way of doing it, but it's the only way to kind of get to the exact premium number you're looking for. So you tick off the ADO, you leave the maximum ticked off, and you kind of play a little bit with the face amounts to get to the deposit level that you want at 28,250 or whatever the number happens to be. And then it says premiums from year 9 on or 10,000 only, which again would be coming out of the cash value of the contract. So if I did a quick illustration just to show you what that looks like, give me a moment, coming up, perfect. So just scrolling down, okay, we have my coverage, my ADO, $17,498 plus my life insurance premiums, $10,752 for my $20,250. The illustration shows deposits of $28,250 for 8 years, but insurance premiums are indefinite, as in the insurance coverage continues. The premiums must be payable. It's a life pay. But going forward after year 9, you are no longer, as the consumer client, making deposits. It's all coming out of the cash value to pay for the $10,753. So the policy continues to grow as the years go on. Okay. So we can spend more time on that at another time. So from here, the software, we would use my AddCalc. Okay, AddCalc would then open up, as we talked about, and I would go into concept. Well, user ID would be your broker name. I'll use Concept Corner. I have John and Jane Smith already here, and I would open up. Sorry, I would create TFSA Maximizer. So again, just to show, here is all my clients. These are my Concept Corner clients I've already built and I've already done some concepts for. Here's if I click their name, here's the below boxes where the concepts are stored. So any quotes that I've done for them. So here's kind of your CRM database. Here is where you are the quotes below. So I would go there. I would, I would put an interest rate of 3.5%. We talked about. The TFSA is 130, as I talked about before. And then continue with the $12,000 deposits. I showed you a screen before where I pressed calculate insurance premium of $28,250. I've already done that. I knew the amount to begin with, so I don't need to exit. I can just continue on. And that's it. I view a PDF, which shows me my fancy concept. Open up here in a moment. Perfect. There we go. So here's my TFSA Maximizer concept. I'm just making it a little bigger for everybody to see. Okay, TFSA Maximizer. Okay, it gives you a great explanation as to why you would purchase this concept. Here's my assumptions I talked about already. And then here's the page we talked about a little bit before, where we looked at the $28,000 going in as insurance premium, TFSA balance being diminished and going towards insurance. And then we start picking up our $12,000 TFSA deposits as the years go on. So TFSA value plus death benefit equals overall estate value, increasing for the overall legacy or amount left to said client. So that is a bit of the TFSA Maximizer. Here's your summary page I showed you before. This is always good. Come back to my slides. So we're getting close to 10. So I just, that is the concept, TFSA Estate Maximizer, where we really married two tax sheltered vehicles into one tremendous solution for our clients. So for material to support you presenting, of course, we're here to help always, but the concept piece is probably the best presentation, because again, this is something we built at Empire. So the TFSA Maximizer concept is wonderful. We have a bit of an advisor worksheet if you want it. Kind of give you a list of prospective clients you've maybe worked with or want to work with that are heavy into TFSAs, but not necessarily getting the most value out of their contracts. You want a little bit of a worksheet to help you. I can help you with that. Life and Money Matters website. This is Empire's marketing website that you're welcome to use and to help prospect yourself from. A lot of TFSA material on here. So help your prospecting leverage some TFSA opportunity discussion there. So Life and Money Matters website. So take advantage of that guy. And that was our concept. So we reviewed the strategy. We looked at the target market. We looked at some case studies and the market material available to you. TFSA Maximizer is a great prospecting concept. It works really well for the conversation starters, reallocation, legacy conversations, looking at different ways of implementing or maximizing an estate. Remember, these concepts have very little to do with immediate need as they do about long-term wants of legacy. So, if someone who is a saver, someone that does have a legacy or family wish to pass along wealth, these are conversations that we can have, and we put them into fancy presentations to help kind of explain the numbers a little more to our end client. So TFSA Maximizer is a unique concept available through Empire Life. That was the 6th of 6 Concept Corner presentations. So this will be added probably by the end of day today or tomorrow. Just going to do a little bit of editing as we finish up the presentation. And it'll be available for you on YouTube to look at and review. And of course, please don't feel you can't do that. You can't get help. Jordan and I are always here and available to help with the concept the concept presentations and how to build them using the best insurance solution possible. So the presentation is now complete. I thank you for your time.